Having seen concepts or assumptions in the previous module, now let us come to conventions. Conventions are nothing but the practices being followed. So whenever we talk about GAAP, we say it is region oriented, country wise. So what are the practices being followed in the particular region in the country? We have number 1, Convention of Materiality, 2, Convention of Consistency, 3, Convention of Conservatism, and 4, Convention of Disclosure. Let us pick up one by one, learn them in detail. As said by me in concepts, these are learnt twice, one in the very beginning where you get to know what it is, then throughout the course you will be having in various chapters a detailed reference for this, where we will revisit these topics. So we will start with the first one, that is Convention of Materiality. Data is recorded separately if it is material enough, otherwise it can be clubbed or combined and recorded as a common data. Basically, we classify the data into material and not so material. When we say material, the simple meaning, a knowledge about this will influence the decision making. When I say not so material, it may not influence decision making. When we report data, paisa may not influence decision making. Similarly, just buying tea or coffee for employees or spending very less amount for say photocopying and so on may not influence decision making at large. So those things we can, for example, say as not so material. So what the convention says, if an item is material, make a separate record for it. If an item is not so material, don't ignore it. Instead, you can combine them. In a day, 10 times if you take photocopies, or in a day 2 or 3 times you serve tea or coffee to all your employees, don't record every item separately. It's not worthy to spend so much of time, money and energy. Instead, you can combine all them and you can call it as photocopying expenses or staff welfare expenses. Under one head, you can club all the amount and you can write it. Similarly, you can ignore the paisa. You can just state it in rupee terms. So these are all the practices being followed by accountants, which we call as Convention of Materiality. But a major problem in this convention is how to decide what is material, what is not so material, and is there a possibility of committing errors or even having frauds and scams here? That is where we have a simple check system, where whether it is material or not is decided by, or it is a decision taken by the accountant, but it is confirmed by the auditor. If the auditor says he can't accept, then definitely accountant cannot call it as material or not so material. So that is where the internal check system works well. And the auditor finally agrees or confirms whether an item is material or not. So having seen the Materiality Convention, now let us come to consistency. In accounting, there are areas where multiple ways of calculations are available. If we choose one method, it should be consistently followed period after period. Even though it may be a bit early to discuss, let me give you an example. There are different ways of computing the value of inventory or stock. We have methods like FIFO method, LIFO method, and so on. Every method comes out with its own value. So this year if you choose one method, and next year if you move on to another, definitely the value will change, and because of that profit figure will change. When you look at the overall profit at the end, you will be confused. Is it because of a change in the calculation methodology that the profit has changed, or because of any other factor? So to avoid such confusions, the practice says if you choose one method, consistently, period after period, follow the same method. Don't keep don't keep shifting from one to another. Similarly, in depreciation, we have different methods of computing, like straight line method, written down value method, sum of years, digits methods, and so on. If you choose one, consistently follow the same method period after period. That's what convention of consistency says. The third one, a bit controversial and also a bit interesting one, convention of conservatism. It says, provide for all possible losses, but not for possible gains. Meaning, if you foresee a loss, immediately deduct it from the profit or reduce the profit by that amount. But wherever you are foreseeing a gain, unless you realize it, don't add to the profit. You may wonder why. The simple reason is, at any point of time, the profit figure that you show should be a conservative figure, meaning a sure shot figure. Whenever you foresee a loss and you deduct the profit, and later if that loss is not happening, we can always add back, meaning profit will only go up, it can't go down further. But if you foresee a gain and add it, and later it is not happening, you have to reduce your profit, which means the profit figure what you showed earlier will go down. So whenever we say conservative, we mean sure shot, meaning at the best. So whatever you do should improve the profits, it should not bring it down further. That is what convention of conservatism is. What is the controversy here? What is the problem here? Many feel you are understating your profits. Yes, profits are understated, but that's the meaning of conservatism. But again, as we discussed earlier, we have an internal check in the name of auditor who will confirm it. Meaning, you can't play around with figures just to understate. There should be a logic and there should be a process which will be confirmed by the auditor. Let us take an example to see this. Assume on April 1, you sell goods worth 10,000 rupees to a person living in your own street for a month credit. So he says by May 1, he will give you the money. From April 1 to 15, you keep seeing him every day. Somewhere from April 16 to 23, you don't see him at all. You're a bit surprised or even shocked. What happened to that guy? Why he is not to be seen? On April 24, you check with his neighbor to know that he has vacated his house without any information to anyone. What will be your state of mind? What is your opinion about this guy now? Will you have a fear about the 10,000 rupees you have to get? Will you call it as a loss or a probable loss? Definitely, it is not a loss. Why? He has taken 1 month credit, meaning by May 1, he has promised to pay you. It's hardly April 24, so why should we bother? And in between, he has not told that he will not vacate his house. But definitely, it is a probable loss. Why? The way the developments have happened tells you that probably this guy has vanished and he may not give you the money. So definitely it is a probable loss, but it is not a loss. So what this convention of conservatism says then, even though it is a probable loss, deduct it from your profit as if you are going to lose it. Exactly by May 1 or later, he comes and gives you the money, you can always reverse it back so that your profit figure will only go up. So to repeat, conservatism talks about sure short profit figure. Now the last one, Convention of Disclosure. It says, disclose all the transactions, never hide any. Meaning, don't generate black economy. What is black economy? Unrecorded, unreported transactions or black economy. So this convention says, disclose all the transactions, never miss, never ignore, never hide any transactions. So these are all the conventions that we have with us, the practices being followed. Thank you.